Hi, my name is Julia, and along with Mia and Boris, we're going to discuss the financial statements for DoorDash in the year of 2021. Um, Initially, we're going to discuss the competitive environment that DoorDash inhibits and how the food delivery service uh, area is tough, but that DoorDash dominates it at this point. The DoorDash business model aims to benefit both users and restaurants since it allows individuals to order food and beverage from different places on one single platform while providing the businesses with an extended customer base. For industry competition, DoorDash is at the head of its industry. It has 59% of consumers' meal delivery sales in May of 2022, with Uber Eats coming in second at 24%. For the threat of substitution, the battle for customers in this industry is intense, especially as customers are not loyal to one service or another. Um, and restaurants might form exclusive delivery partnerships. More diners are going to have to hop between apps due to this to cover all of their favorite takeout spots. Grubhub's former CEO called these users promiscuous customers and cited them as a hindrance to the company's growth. Not every restaurant or cafe around the world needs to jump into offering delivery immediately, but they will sooner or later have to look at how delivery is impacting their industry. According to the New Yorker, food delivery orders made up 7% of restaurant sales in the US in 2016. And then over the next few years, the number of diners ordering delivery and takeout steadily increased. With people forced to stay home due to COVID-19, those numbers jumped significantly. Americans ordering takeout went from 19% in February of 2020 to 22% in March and April of 2020 once the pandemic started picking up pace and everyone was staying home and having to order food. As for the bargaining power of the buyers, the average sales per customer has increased at meal delivery companies, especially during the pandemic. DoorDash and Uber Eats have seen the most growth over the past couple of years. And so the buyers are able to bargain a bit more, but they do only have these limited options of these four major companies. I'd like to mention that because of the industry that DoorDash is in, there's another group of people with bargaining power, and that would be the drivers for the companies. They're independent contractors and they're people looking for flexible jobs with adaptable timing and good tips. And so these companies that are within this industry must compete for drivers as well. They have to offer fair pay, they have to offer other benefits and things to these gig workers who can drive for any of them, really. And so if DoorDash can't be competitive in that arena, then they will lose drivers and therefore lose customers. As for the threat of entry into the new market, due to intense competition, the threat of new entrants is quite low. Um, because of the explosion of the food delivery industry during the pandemic, uh, any new company that wanted to enter the market at this point would be so far behind that they would have real trouble catching up just because they didn't benefit from those couple years of the pandemic where these companies really took off. You can see on that chart on the left where they all spiked during 2020 and continued to increase. And so any company that enters the market at this point wouldn't have the benefit of the pandemic. So consequently, the possibility for companies to enter the food delivery industry and be successful is rather small.
So that leads us into the analysis of the financial statement, starting with the balance sheet. But before I dive into it, just a quick overview. The balance sheet is comprised of three major sections: assets, liabilities, and equity, where the summation of the liabilities and equity are equal to the assets. Liabilities and equity are also known as non-owner and owner financing. Owner financing is sourced by raising money from stockholders by issuing stocks, and non-owner financing, also known as debt, represents the money borrowed from banks or creditors. So I've divided the balance sheet into those three major sections to take a closer look at each of them, starting with the assets. The two largest assets, and also the ones with significant year-over-year change, are cash and short-term marketable securities. The substantial amount of cash comes from their IPO in December of 2020. If we took a peek back at their cash at the end of their 2019 fiscal year, we'd see that it was just under 260 million versus their now 2.5 billion. In 2021, DoorDash made some acquisitions, which Julia will dive into later, that are the cause for the spike in the short-term marketable securities and also the drop in cash. Those two assets combined with the remaining short-term assets make up almost 70% of DoorDash's total assets. Given that DoorDash is a tech company that doesn't require a substantial amount of infrastructure like manufacturing facilities and warehouses, it isn't surprising to see short-term assets making up the bulk of their assets. Even prior to their IPO, short-term assets comprised the majority of their assets. Moving to the liabilities portion of the balance sheet, you can see that their largest liability is accrued expenses. There's a significant jump in accrued expenses, likely in anticipation for the acquisition that I mentioned earlier. In an effort to build up cash, DoorDash recorded these liabilities like utilities or interest payments, but didn't necessarily pay for them in order to have additional cash on hand. This would usually be some cause for concern, but as I'll talk about later, DoorDash remains a solvent company with the ability to pay all of its debts. Only 31.5% of their assets are financed by non-owners, meaning the company doesn't have much debt. This is pretty standard for a newer industry like food delivery, because newer industries and less established companies pose a bigger lending risk for banks and for creditors. The last portion of the balance sheet is the statement of stockholders' equity. The only positive number that we see here is the additional paid-in capital. This represents the difference between the price at which the stocks are issued and their par value. The par value is outlined by the charter of the company, and it's pretty typical for it to be much lower than the actual share price. The increase in additional paid-in capital year over year means that DoorDash issued additional shares. The next noteworthy line item on this slide is the accumulated deficit. This means that DoorDash hasn't made a profit since their inception. At face value, this seems like a major weakness of the company, but because their liabilities perfectly match their assets, it looks like they're using a liability matching strategy. This is where a company matches its assets against its liabilities to create excess cash that can be used to make further investments that would increase their profitability. Because the margins in this space are so low, DoorDash needs to have substantial volume to be successful. This increases the need for rapid expansion, which requires a heavy amount of investing. The last thing to note on this portion of the balance statement is that DoorDash hasn't paid out any dividends to its shareholders. This is because they're focusing their efforts on expansion and reinvesting in the company. This final slide on the balance sheet uses all three portions of the balance sheet to make some quick calculations for further analysis. Both the current and quick ratios are measures of liquidity. The difference between the two being that the quick ratio leaves out some of the less liquid assets in an effort to assess the company's ability to meet its current liabilities without liquidating inventories. Because DoorDash has a substantial amount of cash for the reasons I talked about earlier, like stock issuance and their asset matching strategy, both of these numbers are greater than 1, which makes it a liquid company. Their asset turnover ratio is a little low. We expect to see a number greater than 1 to indicate that the company can generate enough revenue to sustain itself. The acquisition I mentioned earlier inflates the total assets, which decreases the ratio slightly. This is because short-term marketable securities increase assets, which is the denominator of the ratio, without necessarily increasing the sales, which is the numerator. But I still think this falls in line with their expansion strategy.
Next, I'm going to speak on the income statement for DoorDash. So the income statement is one of the 3 major financial statements we're going to be covering today. It measures the financial performance over a specific accounting period. It shows their profit and loss over any period. And the major categories of the income statement include revenue, cost and expenses, interest, income or expense, and net profit or loss. And from 2019 to 2021, we witnessed very high sales and marketing costs due to the pandemic and the shift in consumer demand to meal delivery services. DoorDash is spending tremendously on customer acquisition costs, such as sales and marketing, to develop their brand loyalty. In the end game, their goal is to capture loyal customers to their platform of delivery services and to be able to increase fees and prices in the future. So here we see the common size income statement for the years December 2019 to 2021 in millions. It demonstrates the major categories as a percentage of sales to show significant and major trends throughout the years. In here, we see that there's a relatively stable gross margin percentage as the cost of revenue has increased almost proportionally to expenses in 2020 to 2021. Their sales and marketing expenses were extremely high in 2019 due to the onset of the pandemic ad spending, and this contributed to a very high operating loss in 2019 of negative 70%. And the total cost and expenses throughout the years are greater than the revenues, although we can see that operating loss is seen shrinking significantly in 2020 to 2021. So they incurred a net loss all these years, but we're still seeing a significant improvement in cost efficiency. DoorDash generates revenue through various ways, such as commission, service fees, marketing, delivery charges, and subscriptions. Commission is that they charge a percentage of order value from the restaurant on each order placed by the customer, and this is their main channel of revenue generation currently. Their restaurants must choose between three tier models: the basic 15%, the plus 25%, and the premier 30%. The basic 15% is with the highest delivery fees for the customer and has a very limited delivery area. The 25% commission tier has reduced delivery costs, an expanded delivery area, and inclusion into the loyalty program. And the premier, which is the best, has the lowest fees, the largest delivery area, loyalty program, and the warranty of 20 deliveries a month. Otherwise, if it's not used, you get a fee refund. And the graphic on the slide illustrates the whole picture of revenue creation and cost allocation between DoorDash, the restaurant, and the consumer. So additional revenue creation that DoorDash uses is marketing. They charge restaurants for their advertising and sponsoring. They also include a delivery charge on most orders, which is a $5 to $8 delivery fee depending upon the area and the distance traveled. They also employ a service fee, which is a small percentage of the subtotal that they use to cover a variety of expenses. And this includes like developing their technology further, marketing, and payment processing. And lastly, they have a monthly subscription model called Dash Pass, which charges people $10 a month. And this includes unlimited free delivery and reduced service fees for customers. So DoorDash is a cost of revenue business rather than a cost of goods sold, because DoorDash does not itself sell any goods, but rather it provides a platform for connecting people to restaurants and delivery drivers in order to facilitate meal delivery. Their direct cost for running the platform, and for each unit delivery involve the labor of the delivery drivers, the overhead that's allocated to operating the platform based on each delivery, and the sales discounts or promotions provided by DoorDash. Their indirect expenses include sales and marketing, research and development, and general administrative expenses. And these costs do not impact the unit delivery of each item sold, but rather than the total expenses. We can analyze a few of the financial ratios found on the income statement, include the earnings per share. From 2019 to 2021, DoorDash retains a negative earnings per share. This means the company has negative accounting profits. As seen, the earnings per share is improving, but the company is still unable to turn a profit for its investors. This should not be surprising considering the new nature of the meal delivery business and DoorDash's current expansion strategy. The profit margin ratio is the ratio of profit remaining from sales after all expenses have been paid. DoorDash is improving their cost efficiency, but is still unable to drive profitability. Since net income is negative in this case, I think free cash flow can be used instead to gain a better understanding of the company's financial situation. And we see also that the ROE, which is the return on equity, has been negative and consistent in 2020 and 2021. And new businesses such as startups typically have many years of losses before becoming profitable, making return on equity a poor measure of their success and growth potential. And it doesn't necessarily mean that the business is in a bad position, especially when the costs in this case are for DoorDash improving the business and focusing on investing in enhanced operational efficiency and customer acquisition. So this does affect the bottom line of the return on equity number, but it is not a great gauge to measure the financial success of the business. And we're also going to discuss the strengths and weaknesses viewed from the income statement. And the strengths include that they're strong in expanding their revenue and their revenue generating activities in the past 3 years. They are successful in improving their cost efficiency on a yearly basis. And as we saw earlier, the earnings per share and profit margin ratio are trending upward. So this is all contributing to them as establishing themselves as a market leader in the food delivery business. So the negative aspects of their costs are not necessarily a bad reflection of their financial success. And their weaknesses include that the company has recorded significant net losses since inception, and it has yet to report a period of profitability. So this generally weakens investor interest and hinders the company's ability to further finance its operations through the stock market or using the debt market.
So I'm going to discuss the statement of cash flows. The statement of cash flows reports the change, either an increase or decrease in a company's cash balance over a period of time. The statement of cash flows is broken down into 3 categories: operating, investing, and financing activities. For DoorDash specifically, we're going to focus on the company's acquisition of Finnish company Wolt, which had a large impact on the business's global reach as well as their cash flow statement. So DoorDash acquired Finland-based delivery provider Wolt for $8 billion. Wolt operates in 23 countries, 22 of which will be new markets for DoorDash. Currently, DoorDash operates in the US, Canada, Australia, and Japan. Wolt was reported to have done $330 million in revenue in 2020 and has 2.5 million active users on its platform with an annualized total transactional value of more than 2.5 billion. It employs 60,000 couriers and caters to over 10 million customers in 129 cities across the 23 countries that it services. These statistics make Wolt an excellent opportunity for DoorDash to continue its growth throughout the world. The acquisition immediately impacted DoorDash's operations at the end of 2021. The company fulfilled 347 million total orders in the period, a year-over-year increase of 47% and a slight increase over the previous quarter. Those orders generated marketplace gross order volume of 10.4 billion and an increase of 44%. If the merger goes the way DoorDash is hoping that it will, it'll lead to DoorDash posting its first full year profit, maybe up to $500 million. Here we can see that the company operates at a net loss, which was discussed previously in the other financial statements. However, after reviewing the operating activities listed on the cash flow statement, we can see that the operating activities are generating cash and increasing year over year, with a large jump in 2021 due to the pandemic, which had a huge impact on the food delivery industry, as we discussed, and the acquisition of Wolt also impacted their increasing operating activities. The chart here, the graph shows the past 4 years of operating activities. You can see the operating activities in the recent 2 years, it have begun to generate cash, and in the previous 2 years, were not generating cash. DoorDash assets and liabilities for 2021 saw a 115% increase from 2020, which is incredibly significant. And as I said, a lot of it was due to pandemic growth and the acquisition of this Finnish company. The investing activities, we are focusing on the marketable securities because they had the greatest impact on the net cash used in investing activities. And this category is much greater than the cash spent in any other category in 2021 and in previous years. Marketable securities are liquid financial instruments that can be quickly converted into cash. These securities tend to mature in a year or less and can be either debt or equity. DoorDash finalized its deal with Wolt in June of 2022, at which time it likely liquidated the investment in marketable securities to help pay for the deal. Like I previously said, was an $8 billion deal. The graph here also demonstrates that same investing activities numbers and the increase in the investment activities for 2021. And then on the right, you will see the graph that specifically represents marketable securities and the investment that was made into marketable securities during 2021 and how significantly more it is than the marketable securities that were purchased in the previous years. It was a 966% increase over 2020, so very significant. Financing activities relate to long-term debt and stockholders' equity. Cash inflows result from borrowing money and issuing stock to investors. Outflows occur when a company repays debt, repurchases stock, or pays dividends to shareholders. The issuance of common stock that you see in 2020 for 3,294 is due to their initial public offering in December of 2020. So they had an influx of cash due to going public. The stock rose 86% above its initial public offering price of $102 and closed the day at $189.51. So very, very significant for the company to go public. On the next slide, you'll see the graph where in 2020 we do see that spike from them going public. In 2021 it does level off as expected because they had a huge year in 2020 by going public. DoorDash's IPO was one of the largest IPOs of that year. And so in 2021, we see 112% decline from 2020.
So with that, I'll finish up with some key takeaways. Despite consistent increase in revenue generation as seen on the graph to the right, DoorDash's liability matching and expansion strategies have led to an increasing accumulated deficit. They have been improving their cost efficiency by leveraging customer loyalty to increase prices to both customers and restaurants through service fees and commissions. As they continue to expand their business, they have a high customer acquisition cost due to the investment in sales and marketing. And last, the acquisition of Wolt has had a substantial impact across all of their financial statements and is the most recent step in their aggressive expansion. The brand can be seen making acquisitions, giving them access to top technology like self-driven cars that may soon be employed in its business model to assist with their expansion efforts. Thank you.